Welcome to Risk Finance Regulation 360, your space for clear, careful insights into risk, regulation, and modern finance. What if carbon credits redefined modern finance? Today, we embark on a journey that transforms sustainability into strategic opportunity. In 2026, institutions are not just talking ESG, they're investing in carbon credit trading as a genuine asset class. Climate pressures are fueling a market shift that blends compliance with innovation, paving the way for robust portfolio diversification. By understanding these evolving trends, you will see how environmental challenges evolve into profitable ventures that reshape the financial landscape. The urgency of climate mandates is driving change on a global scale. Today's regulatory environment leaves companies with no choice but to act decisively. Stakeholders, from investors to regulators like the ECB and SEC, are intensifying their pressure. As net zero targets become vital boardroom metrics, vast sums of capital are being redirected. Compliance and transparency are now strategic imperatives. Embracing these evolving dynamics is essential as financial institutions gear up for a significant transformation in the market. Corporate net zero commitments are reshaping market demand for carbon credits. Over 70% of leading companies now embrace these targets, fueling a robust market where offsets are viewed as essential compliance and reputation strategies rather than mere charity. In recent years, corporate buyers retired millions of credits, stabilizing the voluntary market. With increased scrutiny on supply chain emissions, this sustained demand is set to drive long-term market evolution, merging environmental responsibility with rigorous financial strategy. The transformation of carbon credits continues as they shift from a deferred CSR initiative to a dynamic financial instrument. Financial institutions now treat these credits as tangible commodities, much like oil or metals, recognizing their potential for yield generation. Premium pricing on high-integrity credits, especially removals, underscores this evolution. This broadens portfolio diversification and ushers in innovative investment strategies. Understanding these dual arenas is essential for navigating the emerging opportunities in a market that is continually redefining risk and reward. Carbon trading operates in two primary markets, compliance and voluntary. In regulated systems such as the EU ETS, mandatory participation enforces strict rules and penalties, setting a powerful pricing benchmark. Meanwhile, voluntary markets enable companies to offset emissions in a bid to enhance reputation, emphasizing quality and authenticity in credits. These dual ecosystems illustrate the full spectrum of carbon trading dynamics, where regulatory imperatives meet corporate social responsibility. Recognizing this balance is vital as policies and market mechanisms continue to evolve. Focusing on the compliance market reveals a rapidly expanding landscape driven by global mandates. With EU ETS allowances holding steady around €88 per ton, tighter caps are reinforcing pricing stability. Beyond Europe, markets in China and emerging regions like Indonesia and Vietnam are scaling up, creating new arbitrage opportunities. This global expansion not only broadens prospects for institutional investors, but also reshapes competitive dynamics. As banks navigate cross-border strategies, understanding these frameworks is key to leveraging the inherent value of carbon credits in a connected financial world. When evaluating carbon credits, authenticity is paramount. The quality of these credits relies on being derived from verified projects, demonstrating real climate benefits. From nature-based solutions such as reforestation to technology-driven methods like direct air capture, each project undergoes rigorous auditing by authorities like Verra and Gold Standard. This dependable verification not only safeguards additionality and permanence, but it also supports a premium market valuation, with high-quality removals fetching around $26 per ton. This evolution inspires smarter investments indeed. Quality is bringing a much-needed stability to the voluntary carbon market after considerable upheaval. Though pricing fluctuations and policy shifts once created uncertainty, recent recovery restored confidence. Voluntary market values reached up to $2.5 billion, with high-quality credits showing significant price upticks. Persistent inefficiencies continue to open arbitrage opportunities across regions and standards. It is clear that tighter regulations will further elevate prices through 2027 and 2028, prompting banks to transition from passive observers to active investors. This market transformation ultimately reshapes our investment landscape, a dynamic change indeed. Leading the charge, banks are redefining the carbon market by moving from simple facilitation to direct investment. By taking equity stakes in project portfolios, they secure supply and capture early-stage value beyond traditional returns. Their involvement not only yields financial benefits, but also enhances ESG credentials. Major financial institutions are backing significant projects, from reforestation in Brazil to renewable energy in India, aligning capital with high-impact initiatives and locking in integrity through offtake agreements. This proactive approach is spawning innovative financial products. This strategy propels market evolution with clear precision indeed. Risk management and innovation are intertwining as banks create a spectrum of new financial products for the carbon economy. Offset-linked loans adjust interest rates based on net zero performance, while green bonds and funds channel capital into verified removal projects. Additionally, specialized carbon advisory services assist companies in navigating complex regulatory landscapes and optimizing their offset strategies. Bundled procurement solutions further integrate ESG reporting with transition financing. Although growth brings risk, meticulous structuring underpins trust and long-term value. This evolution solidifies market credibility and fosters sustainable progress for all stakeholders. Managing reputational risk is essential for sustained participation in the carbon market. With greenwashing scandals having a profound impact, rigorous verification becomes more than mere compliance. It forms the backbone of lasting asset value. Identifying risks like non-additionality and permanence failures is crucial. Third-party assessments from authorities such as Verra and Gold Standard, along with emerging satellite and blockchain tools, ensure stricter due diligence. By diversifying portfolios and favoring high-integrity removals, we lay the groundwork for genuine, lasting market trust. In doing so, we secure long-term value and credibility indeed. Market volatility offers a unique opportunity to generate alpha. By hedging exposure with futures and options on exchanges like ICE and EEX, banks mitigate price swings effectively. Arbitrage strategies, such as buying in the voluntary market and selling into a compliance-linked framework, further capture value. Proprietary trading desks seamlessly execute spread trades between EU allowances and voluntary removals, turning market inefficiencies into profit. However, in a landscape driven by policy changes, careful risk management remains paramount as we align regulatory insights with strategic actions. This dynamic approach catalyzes progress. Policy is the heartbeat driving this market, and understanding the regulatory roadmap is key for a competitive edge. In 2026, full implementation of CBAM fees along with potential UN Article 6 linkages will reshape dynamics. By 2027, we anticipate growth through the expansion of China's ETS and emerging markets, creating cross-border arbitrage opportunities. As Scope 3 scrutiny intensifies by 2028, more capital will flow toward offsets. Banks strategically positioned in sectors such as steel and cement will gain a first-mover advantage. It clearly defines the modern carbon trading desk. Leading institutions are shifting from passive investments to active carbon trading. They are building dedicated trading desks to capture proprietary gains. The front office now leverages risk models and specialized trader training, transforming execution into a dynamic process. A robust technological infrastructure, complete with integrated APIs and real-time pricing, supports rapid execution. This setup creates a central hub for carbon intelligence and liquidity, driving fee capture and market efficiency. In essence, the strategic shift empowers banks to move decisively from basic facilitation towards comprehensive proprietary trading operations, truly transformative. The carbon market is on the verge of a dramatic explosion, transitioning from billions by 2026 to hundreds of billions by 2030. Long-term projections suggest the market could reach trillions by 2050, driven by a relentless focus on high-integrity removals. New instruments, such as carbon removal certificates, complex derivatives, and blockchain tokens are unlocking liquidity. This growth is further fueled by a blended finance model that mixes public funds with private capital. The strong quality focus ensures price premiums remain significant over time. This evolution marks a critical milestone. Carbon credits are the cornerstone of impact investing, driving the effectiveness of blended finance models. This model combines concessional public funds with private capital to fund expansive projects. Banks arrange these deals by aligning profit motives with verifiable emissions reductions. Reforestation projects, for instance, deliver attractive returns alongside carbon credits and biodiversity gains. This approach de-risks investments, transforming discussion into scalable funding. By linking capital with sustainable outcomes, institutions not only reduce risk, but also generate lasting economic and environmental value, converting impact discussions into measurable funding everywhere, globally. Integration with wider ESG frameworks is accelerating, expanding beyond pure carbon to embrace hybrid financial products. Carbon credits continue to serve as the fundamental asset, ensuring verifiable emission offsets for corporate sustainability. A new pillar has emerged in biodiversity credits, which value ecosystem restoration and nature's services. This convergence extends into fixed income, where sustainable bonds are now linked to net zero performance. Sophisticated hybrid products combining carbon, biodiversity, and social impact are expected by 2027 to 2028. These innovative integrations not only broaden investment horizons, but also establish multifaceted value streams. Leading institutions are putting strategy into action by structuring comprehensive funds and client platforms. Firms like Goldman Sachs have launched multi-million-dollar funds focused on high-integrity carbon removal projects. These initiatives generate returns through credit appreciation, advisory fees, and secured offtake agreements. On the client side, banks such as Morgan Stanley enable large-scale offset procurement integrated with transition loans and ESG reporting. These case studies prove the market is mature, shifting observation into active risk-managed participation. This strategic transition underscores how institutional commitment transforms market potential into financial opportunities. In uncertain times, volatility becomes not only a challenge, but also a powerful ally when its risks are measured and managed with precision. Price swings, scandals, and shifting regulations present real challenges. Yet, these fluctuations open the door to generating alpha through disciplined spread trades and selective investment in high-quality credits. Focusing on integrity is essential to mitigate reputational risks, while regulatory tailwinds offer significant first-mover advantages. How can institutions set the foundation to turn these risks into lasting opportunities? Build your expertise and seize the strategic edge today. Institutions must adopt a clear, phased roadmap that starts with a thorough assessment of their carbon exposure. Evaluate portfolio intensity and identify key transition risks. Next, build a robust trading desk with essential infrastructure, registry access, and well-trained teams. Pilot small trades to refine systems and pricing models. Finally, scale operations by increasing procurement and launching client-focused initiatives. Each step is crucial for balancing risk with opportunity, securing a decisive first-mover advantage. What initial step will you take to transform potential into performance? Set your strategy into motion now. We now transition to the fundamental role of continuous intelligence in the carbon credit market. Success depends on a robust ecosystem that tracks compliance trends, assesses credit integrity, monitors policy shifts, and captures live pricing signals. By integrating these four critical data streams, institutions can navigate uncertainty with greater confidence and make informed decisions. This careful analysis fuels strategic market leadership, revealing hidden arbitrage opportunities while mitigating risk. Embracing a data-driven approach transforms reactive moves into proactive strategy. How will your organization harness this power to lead the market? At this pivotal moment, carbon credits are reshaping global finance. They transcend traditional risk management, redefining capital allocation through profit generation and leadership. Strategic actions today enable institutions to secure outsized returns, As market dynamics shift, embracing decisive, informed moves becomes essential to harness emerging opportunities. This evolution calls for bold financial strategy rather than mere survival. It represents a fundamental reordering of global capital that challenges conventional thinking and rewards proactive risk-taking. The future of finance hinges on the ability to navigate this powerful transformation. Act with confidence. Before concluding, let's review the core strategic pillars. Regulatory pressures and corporate net zero mandates drive an urgent market need. Institutions must distinguish between compliance-based and voluntary credit markets to meet shifting demands. The active strategy involves investing in quality projects, facilitating client offsets, and leveraging market volatility for alpha generation. Integrity underpins every move, ensuring long-term value by prioritizing stringent verification and high standards. This disciplined approach is essential for capturing growth in an evolving market. Now is the moment to consolidate expertise and position yourself for sustained success. To conclude, we have explored the transformative journey of carbon credits. Our analysis shows that market volatility, when managed with integrity, opens powerful avenues for alpha generation. A phased approach to implementation and continuous intelligence are essential to navigate new regulatory landscapes. This comprehensive framework underscores the shift from traditional risk management to strategic market leadership. As financial institutions reassess their strategies, the evolution of carbon credits stands as a pivotal moment in global capital dynamics. The insights shared today highlight the roadmap for enduring success for lasting impact.
Thanks for watching. For consulting and advisory engagements, you can reach us at regalwiseconsulting@gmail.com. Please share your thoughts in the comments and suggest the topics you'd like us to cover next.